All right, guys, this is going to be a jam-packed video. I got my notes. I got an extra camera battery on standby. Get your pen and paper ready because here we go. Hey guys, it's Wendy. Welcome back to my channel, or welcome if you are new here. Just a little bit of context. I am 23 years old. I live in San Francisco and I work in tech. In the past half year, I've gotten really into personal finance, and it's a topic that I'm really passionate about because it is such a convoluted and confusing topic for many people out there. So today I want to break down 4 different personal finance topics or tips. These, in my opinion, are kind of the 4 basic beginner personal finance ideas. This is a topic that for so long I found extremely overwhelming. A lot of the information out there is super complex and uses a lot of financial lingo. It's very difficult for somebody who has not grown up in this sort of world to break into. It's not something that you learn in school. The financial industry literally benefits and makes money off of people not knowing. I think getting into personal finance is definitely a privilege. It's truly only something that you can get involved in and learn about when you have the financial means, the time, as well as the energy and knowledge. I grew up in a family that didn't really talk about finances. I'm the first generation to grow up here. I was sort of forced to learn a lot of this stuff on my own. And that is why I want to make this video, and maybe the information will be more relatable and digestible coming from somebody who looks like me and not from somebody who you would typically envision as somebody who would give financial advice, if you catch my drift. I just want to give a little caveat that I'm by no means a financial expert. I am not claiming to be. I'm just sharing with you my experience and what I've learned through my own research. You might agree with me, you might disagree with me. That's okay. Everybody's situation is different. Everyone's approach to finances is different. So just take what you will from this video. The first topic I'm going to talk about is a high interest savings account. I'm sure a lot of you have heard of just a general savings account and probably have one with a big bank. So the point of a savings account is that it should be a place in which you put money that you don't plan to use for immediate needs and you do plan to use for more longer term future goals. So that might be something like a vacation, a down payment for a house, a car. And it's also the place that you should have your emergency fund. For an emergency fund, people typically recommend around 6 months. So if you were to lose your job, you would have this backup emergency fund to be able to support yourself for 6 months. A savings account sort of draws a line between everyday spending, which is your checking account, it's easily accessible, and then longer term spending. It's definitely a way to force yourself to think more about whether or not you actually need to spend this money or not. So the main perk of a savings account is that you actually earn interest, which means every single month you will literally get a little bit of extra money automatically deposited into your savings account. And the amount of money you earn depends on how much money you have in your savings account. So big banks typically offer very, very low interest rates. The savings account that I used before I opened a high interest savings account offered around 0.03% APY, which is very low, but online banks will offer significantly higher interest rates. APY stands for annual percent yield. It's basically just a single number that represents how much interest you will earn within 1 year after taking into consideration compound interest. So if you think about it, right, every single month you earn a little bit of interest on the amount of money you have in your high interest savings account. You get that money deposited into your savings account, and then the next month you earn interest on that interest that was added the previous month. So let's say that you initially have $10,000 in a savings account. If you have an APY of around 2%, that means that after a year your balance should increase by 2%. So you should have around $10,200 after a year. It really does not take any extra effort to open a high interest savings account, but the rewards are so much higher. All right, my second tip is investing for retirement. I'm sure a lot of you have heard about this topic. I'm sure you've all heard the phrase save for retirement. I think this phrase is constantly thrown around. It should really be investing for retirement.
The reason for this is the money that you put in a retirement fund is not just sitting there, it's actually being invested and growing over time. So now is the perfect time to talk about the concept of inflation. Inflation is just the price increase of goods and services over time. When inflation increases, or in other words, the prices of goods and services increase, the purchasing power of consumers decreases. This just means that consumers can buy less than they once could with the same amount of money. So you'll have to spend more money to fill your gas tank the same amount or to buy the same cup of coffee. Essentially, the value of your money is decreasing over time. In the United States, the rate of inflation a year on average is 3%. So basically, any money that you have lying around that is not growing is just losing value. Unless you are beating or earning more than the rate of inflation, you are literally losing money. A high interest savings account is great, but you're most likely not going to get a 3% return. So that's when investing becomes very important. Investing is one of the most effective ways to grow your wealth because your money basically just does the work for you. Over nearly the last century, the stock market's average annual return before inflation is around 10%. So after taking into consideration inflation, the rate of return is around 7%. So basically, if you partake in long-term investing, then you will be able to beat inflation. Now, obviously, the market fluctuates every single day, but what we are interested in is long-term investing because historically, the market always goes up over time.
So now I'm going to break down this topic even further and talk about 401ks and IRAs. So a 401k is just an employee-sponsored retirement plan. One of the biggest, most important perks of a 401k is that many employers will actually match your 401k contribution, typically up to a certain amount. So this means that if you put in a certain amount into your 401k retirement fund, your company will literally give you free money and match that amount up to a certain amount, like I said. With the 401k, your employer will typically give you a limited amount of investment options and funds that you can invest in. At the time that I'm filming this video, so April 2020, you can contribute up to $19,500 a year to your 401k. And your employer match actually isn't included in the $19,500. So I personally choose to invest in a traditional 401k versus a Roth 401k. So a traditional 401k just means that you use pre-tax dollars. Basically, every month, a certain amount of my paycheck will get deposited into my 401k. And once I withdraw this money in the future, when I plan to retire, I will have to pay taxes on the money. So like I mentioned earlier, you can go in and actually choose what funds you want your money to go to. So I have most of my money invested in a target date fund and then a little bit invested in an index fund. A target date fund essentially is just a basket of stocks and bonds, and this fund will automatically rebalance for you based on when you want to retire. So I chose the 2060 target date fund, which is around the year I want to retire. With the target date fund, the younger you are, the more aggressive your investments will be. So this just means that more of your money will be invested into stocks when you are younger, and stocks tend to be considered as higher risk but higher return. As you get closer to your retirement date, your investments will shift to be more conservative. So this means that more of your money will be invested into bonds, and bonds are typically considered to be more safe, less risk, but also less returns. I think that this fund is a perfect idea for somebody who is just learning about investing, getting into it. You basically don't need to do anything with this fund over time. You can just let it sit and it will automatically rebalance. However, the result of the fund automatically rebalancing means that this fund does come with higher fees, which will take away a little bit from your returns. So just something to take into consideration. But again, I think that this fund is really great for beginners or somebody who doesn't really want to actively manage their investments. All right, so once you have invested enough in your 401k to get the employer match, or if your employer does not provide you with an employer match, I suggest opening up an IRA if you're eligible. IRA just stands for Individual Retirement Account. The big benefit of an IRA is that you have more investing options. So unlike the 401k in which your employer only gives you specific investment options that you can choose from, with an IRA, you can choose whatever funds and options you want to invest in. I'm going to be specifically talking about a Roth IRA because that is what I have. So earlier I explained that a traditional 401k uses pre-tax dollars. Well, a Roth IRA uses after-tax dollars. So that means taxes are taken out right now when you deposit money into the Roth IRA. And then later on, when you withdraw the money, you don't have to pay taxes. So again, just to reiterate, 401k versus IRA. 401k is employer sponsored. IRA is an individual retirement account. And then you can either get a traditional or Roth 401k or traditional or Roth IRA. There are some limits when it comes to an IRA.
So one of them being income. If you make less than 124K, you can contribute up to the max amount. If you make 124K but less than 139K, you can only contribute a reduced amount. And if you make 139K or more, you're actually ineligible to be able to contribute to a IRA.
If you're under 50, you also can only contribute 6K a year. This is for both a Roth IRA and a traditional IRA. So going back to the after-tax, pre-tax idea, for example, if you are younger and you expect to be in a higher tax bracket in the future, it would be beneficial to invest in a Roth retirement fund, whether it be a 401k or an IRA, so that you can get your taxes taken out now and then your money will grow tax-free. Because in the future, you might be in a higher tax bracket, you're going to have to pay more taxes than if you were to just get the taxes taken out when you were younger in a lower tax bracket. But in general, from what I read and from the financial advisors that I follow, it's good to have both a traditional and a Roth retirement account because it diversifies your tax strategy. If you have both types of accounts, even if you don't know what tax bracket you'll be in the future, you'll have both options available to you. To open a Roth IRA, you just need to select a broker that you will be opening the account with. So this can be with Vanguard, Fidelity, Schwab. All right, next topic is going to be about credit cards. So now that I'm reflecting, this is actually what first kickstarted my interest in personal finance, is my obsession with credit card points. The number one thing I would suggest about credit cards is to always pay your balance on time and to always pay it in full if you can. If you don't pay your credit card on time, it will lower your credit score. And if you don't pay your balance in full, you're just gonna get hit with interest. And a lot of these premium travel rewards cards actually have a very, very high interest rate. So I would not suggest leaving a balance if you don't need to. So what is a credit score? This is a term that you probably have heard thrown around as well. A credit score is a single number between 300 and 850 that represents your risk to lenders and how you have approached and handled debt in the past. This number is really important because it is taken into consideration for many things, such as applying for future credit cards, mortgages, car loans. Some landlords will even ask for your credit score to take into consideration when they are deciding whether or not they want you as a tenant. Obviously, the higher the better. Once you have all of your other finances in place and you are confident that you can pay your balance on time and in full, you can start thinking about credit card rewards. And I can definitely do an entire separate video talking about my credit card strategy. But before I even had a credit card strategy, before I switched to Chase, I just literally chose a random credit card to use. I was using the Bank of America cash rewards card for a while, and that's not even a super popular rewards credit card. And even with that card, I was able to earn $300 in cash back the last full year that I was using it. That just shows you how beneficial credit cards can be if used properly and if you optimize them. I suggest choosing a credit card that fits your lifestyle. What I did when I was comparing and trying to choose the best credit card is that I literally created a spreadsheet in which I added all the multipliers and I calculated my yearly spending from the past year and I inputted them into the spreadsheet to see which card would just give me the highest yield, taking into consideration annual fees and such. As Sebi is a financial YouTuber that has created a lot of credit card spreadsheets like this, so you can definitely head over and check out some of his videos to find spreadsheets in which you can literally just input all of your information and it will tell you which credit card will give you the most cash back. So typically my strategy for credit cards has been to choose credit cards that allow you to redeem your points for more than just 1 cent per point. So I have the Chase Sapphire Reserve, which is 3x points on travel and dining, and you can redeem those points for 1 cent per point for gift cards or direct deposit. But if you choose to redeem those points through, for example, the Chase travel portal where you can book flights, then 1 point is actually worth 1.5 cents. And if you choose to transfer your points to one of Chase's travel partners, they can be worth 2 cents. So if a credit card only offers one redemption option and the redemption option is 1 point for 1 cent, or like my Bank of America cash rewards card, which was just 1 cent was equal to 1 cent. They're basically the same thing. That is just not the most value you can get from your points. I would recommend going for a card in which you can essentially have more redemption options and redeem your points for more value. Although I do understand some people prefer to get statement credits or gift cards or direct deposits over using their points in a travel portal or a transfer partner because it is easier and less confusing. That's totally fine as well. But this is my strategy that I've been using. Okay, so now we are on to our last topic. You have made it. Round of applause for yourself, pat on the back. And this topic might be the most confusing and the topic that I think there is the most talk around, especially if you are a millennial or Gen Z. I think people love talking about investing. Just to put together all the topics that I've discussed so far into sort of a ladder of personal finance, and this ladder was based off of the one that Ramit suggests in his I Will Teach You to Be Rich book. The way I see it is that first you want to pay off any debt you have. So this might be student loans, credit card debt, and then you want to put in enough money to get your employer match from your 401k. If your employer does not match, then skip this step and go to the third, which is just to put money in your IRA. Once you've done that and you still have extra money, then go back and put more money into your 401k. The ideal would be that you would be maxing out your 401k as well as your IRA. The IRA is obviously easier to max out because it's only $6,000 that you can contribute a year. And then after you've done all of that, that's when you want to focus on outside investments. In order to invest in funds that are not retirement related, you're going to need a taxable brokerage account. Now, this can be with the same broker that you opened your IRA with, or it can be with someone different. I would do your own research. ETFs, which is what I prefer to invest in.
So ETF stands for Exchange Traded Fund, and they are a basket of securities that contain multiple stocks, bonds, and other assets. Here are some of the types of assets that might make up a basket. So a basket can contain a combination of these types of assets, or it can just have one type of these assets. So for example, you could invest in a bond ETF that would include a bunch of different types of bonds, or you can invest in something like an industry ETF, which focuses on the stocks and securities of a particular industry or sector, such as tech or finance. And that's one of the really great things about ETFs is the fact that there are so many different types that focus on different assets, industries, regions. There are some that track market indexes, such as the S&P 500. So you definitely have a lot of options to choose from when it comes to investing.
Investing in a basket of funds allows you to easily diversify your portfolio. That is a very popular phrase that is used in the investing world. It basically just means not putting all your eggs in one basket, which is what you would be doing when you are investing in individual stocks. So if you buy stocks from one company, if that company doesn't do well, you basically are at a really great loss.
Now, when you buy one share of an ETF, you end up holding multiple securities. So for example, if you invest in an industry-focused ETF, your money is going to be dispersed across a bunch of different companies within that sector. So if one of those companies crashes, the loss will not feel so extreme because the ETF is diversified across many more companies beyond just that one. Ultimately, this just means less risk.
The main benefit of ETFs is they have very low fees. I choose to invest in an S&P index ETF. The S&P 500 represents 500 of the largest US companies, and the fund basically just closely tracks the index's return, which typically is seen as an overall reflection of how the US stock market is doing. In general, this is definitely the area that I still have a lot more to learn about. It is for sure, I think, the most complicated area. One piece of advice I would give is just to follow the 80% rule. Ramit mentions this in his book. You don't have to be perfect, but starting somewhere is better than not starting at all. All right, you brave souls who have ventured to the end of this video. Thanks so much for sticking with me. I really hope you were able to take something from this video. This is a video that I've been wanting to do and I've been planning for a very long time. I think all of these topics are so important. This type of information is so difficult to obtain in our society. Again, this is just my experience. This is just my knowledge with all of these topics. I encourage you to do your own research. Everyone's situation is different, and there's definitely not a one-size-fit-all approach when it comes to finances. So with that, that is going to be the end of this video, and I will talk to you guys next time. Bye.